Now let's look at the sectors. There are 11 sectors that we've mapped out here. And in a similar way, now that I've shown you how to read the charts, these are again sorted by rate of change from a 2-month. Technology was by far the biggest mover, up 3.79%. That's the XLK. The second biggest mover was discretionary. And guess what's the key mover of discretionary? It was Tesla. Tesla is in the discretionary sector. It had a big move, helped the XLY have a 3.62% rally. Industrials was the next big mover at 1.82% for the week. Real estate at 1.62. XLP, staples at 1.54. Utilities at 1.16. Financials at 1.09, energy at 0.81. The communication sector got a hit because of last week on Netflix and this week. So you notice that last week got a big hit. Netflix earnings didn't help. And then this week it got hit with Meta. So, and this was the big gap down drop because of Meta as a big component of XLC. Today, the reason got the gap back up was Google. Google is also in XLC. Google helped get the lift, but this drop was primarily Meta driven. Today, Meta did get a bit of a snapback rally. And then the healthcare was actually up 0.73, and the basic materials was up 0.63. So in the industrials, across the 11 sectors, everything was positive for the week. There was no negatives. So that's very interesting that all the industries this week had a positive move. But if you look at the trends on the 20 and the 50-day, the bearish crosses, you can clearly see which are the bearish looking sectors. Technology, heavily bearish looking. The 20-day pointing lower, the 50-day having curve pointing lower, a bearish cross, a bearish looking chart, bearish looking trend. Discretionary, same thing. The 20-day curved lower, the 50-day has also curved lower, a bearish cross, means that both of these failing at their declining 20-day could resume a downward climb. XLK, XLY failing. In fact, XLY couldn't close above that 20-day. If you look at the candle close was where the top of this rectangle is, below the 20-day. So it failed to close above it, a bearish sign. Industrials, same thing. The 20-day has curved lower. The 50-day is plateauing, has not curved lower yet, but this is headed for a bearish cross. So that does not look good for industrials either. And guess what? It could not take out the 20-day today, closed below. Real estate already has the bearish cross, the 20 days below the 50, both are declining, and not a good looking chart either. Staples actually had a very strong move the last couple of weeks. They're the defensive plays. When the rest of the market, the growth stocks, the aggressive sectors pull back, the defensive start doing well. So the Staples XLP had a very big upward move, but guess where it failed? It failed right at resistance at the previous late of March peak near 76.5. It failed. It closed yesterday with a bearish candle. Today also was a bearish reversal candle. So it's possible that the Staples could at the end have a bearish cross of the, it already had the bearish cross. The blue, if you look at it, has gone below the red. Red is still climbing, but if the blue picks momentum, the blue 20-day moving average picks momentum on the downside, you could expect the 50 to also start turning lower. So that's not kind of an early stage of a double top near 76.5 and then potentially a decline for Staples. Utilities actually has a more bullish looking chart. Why? The 20 and the 50-day are climbing. They're both trending higher. No bearish cross. It's actually a bullish cross, 20 above the 50 from early March or mid-March, and climbing in a steady way. So that's potentially possible that the utilities, unless this chart changes where XLU drops drastically, it could be one of the bullish sectors that outperforms the other sectors for the next few weeks. Financials getting ready for a bearish cross, the blue curving lower, the 20-day below the 50-day, and something to watch and see if this picks up bearish momentum. Energy is also bullish looking like utilities. You can see clearly here that the blue line is above the red line, both climbing. It reclaimed the 20-day for most of this week. However, today it closed below it. So it's something to watch next couple of weeks. Is it possible if the, West Texas crude or the, price of oil goes and crosses $100 a barrel, it's a good chance XLE continues its rally. So something, and if the geopolitical stresses continue, it tends to be bullish on oil, and that's something to watch. Communication sector is bearishly inclined. The 20-day is declining, 50 days plateaued out. This is getting ready for a bearish cross, something to be cautious about. Healthcare also had a bearish cross. The pharma stocks recently have got a sell-off. In fact, the darling Eli Lilly got a pullback, and so did Novo Nordisk. And that's something that we can notice here, that the blue has curved and started declining in earnest. That's the 20-day. The 50-day in the red has also curved and started declining. This kind of a bearish cross failed. The XLV tried to muster a rally, could not make it to the 20-day, and it started declining again. And basic materials, by the way, the only thing that is helping it is the precious metals. They're part of it. But then remember, there are economy-sensitive basic materials there. There's steel stocks, aluminum stocks, look at copper stocks. Those are economy barometers. If the economy is not doing well, points of slowing down the economy is there. And guess what the biggest reason is? Next week, Wednesday, is the Federal Reserve meeting with heated inflationary data. In fact, today we had the core PCE data. The number was, headline was 0.3% month over month, and we got 0.3. But if you look at a 3-month rate of change on that, the 3-month number came in at a lot higher at 4.4, and trending higher, it was 3.8 the previous month. That did catch the market by a little bit of surprise. The market overall kind of said that, you know what, PCE at 0.3 with a slowing GDP is not a reason to be concerned about. So today, as a result, the 10-year yield did not resume its climb. It got a little bit of a pullback. But we'll see what happens with next week, and with the Fed coming out on Wednesday. And also Chair Yellen, she's the Treasury Secretary. She might come out and make some statements about there's some auctioning in terms of what are the plans for more treasury auctions in the near term. That could have an impact to the supply demand of the treasuries and could have interest rate implications. But basic material bottom story is also bearish looking. The 20 days declining and the 50 days climbing. But if the 20-day declines, crosses bearish and moves lower, the 50-day could also, the red line could also curve out and start heading lower. So that's the sector analysis.